Thanks for tuning in to this episode of the Resilient Advisor Podcast. My name is Jay Coulter. This is the first in a new series on the podcast called 3 Questions on Today's Markets, where I ask industry thought leaders 3 simple questions that require insightful answers. What has happened in the markets? What will happen in the markets? And what should financial advisors and investors do? Today is October 12th, 2018, and we are recording this pre-market open. And joining me is Clint Sorenson, who is the Chief Investment Officer of WealthShield. Clint holds the CFA and CMT designations. Clint, thanks for coming on. Let's get right to it.
Thanks, Jay.
All right, so this has been a very volatile week. What's happening in the markets?
Yeah, I think it's a multitude of things. I think the trade wars with China, I think JP Morgan's report coming out saying that was their base case, right, that they were expecting a full-blown trade war, I think shook some things up. I think you're seeing a continued weakness in global equities and global equity markets in relation to that. And I think the rhetoric out of the Fed, I think those things are really what caused the jitters in the marketplace. From a narrative standpoint, as you know, Jay, we look at everything from a rules-based framework. And when we look at everything, we're looking at it and we're saying, hey, essentially what is going on currently in the marketplace and how is that causing the market dynamic to shift? Because it's easy in hindsight to go back and kind of fill the narrative. And when we look at that and we look at some of the work that's gone on, we saw some key things. The global markets, they've broken down all year and they've broken key levels. China was down 20% prior to the recent market volatility here in the U.S. We saw European markets topping, most international markets negative year over year. And when you look at that and you see that and the divergence between the global markets and the U.S., it just wouldn't last for too long. So from that standpoint, we looked at that and saw that as the big warning signal. It wasn't anything for us to take action on, because you never know if it's going to be the big one, right? The big decline until later. But over the course of this week, we've seen some major technical damage. So it is really shifting the investment landscape. I think interest rates have also played a part. Obviously, when interest rates move up, you have to reprice assets. And I think that has been concerning. So that's really kind of it's an amalgamation of a lot of stuff that's just not positive for market.
Let's go back to the Fed. Could Powell walk back his comments from this week? How does he do some type of damage control, or is it even needed?
Yeah, I don't think it's needed. And I think that would actually shake confidence, right? I think the Fed has to maintain its independence from the government, right? I think that's the key. The Fed is not independent of the member banks, right? It's a quasi-government entity appointed by the government, but it's really there to support the member banks in the banking system. And so I think when you understand what the Fed's fiduciary duty is, right, or who their fiduciaries for, i.e. the member banks, I think walking back the comments just shakes confidence, and I don't think it's necessary.
Could you give us some historical context on trade wars and their impact on the markets?
Yeah, it's hard to see. We can look back into the 30s, right, and look at the Great Depression during that period when trade wars were more commonplace. And when you look at that, you see a pretty negative effect. We did a recent commentary where we published on what happens if there's a full-scale trade war. And we used our partners at Hidden Levers to help us kind of model it out. And when you look at that, you could see pretty aggressive market declines if we go into a full-scale trade war like we saw during the 30s. And when we were modeling that, we were looking at 30 to 50% declines in the major indices. I don't think that's out of the realm of possibility here if we continue down this path. I would have to say that the trade wars were one of the most underappreciated risks from our firm's perspective. We didn't appreciate it. I thought this was political rhetoric. I thought it was going to be a short-term solution that looked to be beneficial for the Trump administration and a long-term solution that was going to be beneficial for the Chinese economy. right? Continue to push them on a global stage, continue to push the yuan as a global reserve currency. I saw that as the path, but now we're right up on top of midterms, and we haven't had a resolution yet. And I think we saw commentary yesterday that there was going to be a meeting at the G20. Who knows if that happens or not? But I think that was a really underappreciated risk from our perspective, and I think that the market and us as well are getting caught up to the fact that this is a real possibility now.
Yeah, I think that's caught a lot of people by surprise, Clint. Let's pivot and talk about what you think is going to happen in the markets going forward in the short and intermediate term.
Yeah, so short term, I mean, I think like you and I talked, I wish we'd had this yesterday when I was talking about it. We're really technically oversold, so expect a bounce, and I think the bounces always tell the truth, right? What happens in a bounce after you've done so much technical damage? Can you reclaim it? Can you reclaim some key levels, right? Break back above some key moving averages that are heavily watched in the trading community? Can you make some positive efforts to start the trend back upward? I think that's all very important to watch for in this bounce. What I expect to happen is from this oversold level, a bounce that most likely ends in somewhat of a consolidation period, maybe a move back to new lows, but I think momentum won't be as won't be as negative in that regard, and so you get what we call a divergence, and that divergence I think will result in what we would call the true bounce, which would be a longer term move back up, probably towards the end of the year. But I think, hey, if we can't reclaim some key levels on that move, I think that we're going to resume the trend down, and that's more of the longer term picture. Is that, hey, this could very well be a trend change. We've seen the 200-day moving average broken on the S&P 500. Now, whether it stays below that remains to be seen, but that's heavy technical damage. And when we look at that, we want to see how do we handle this bounce, and then can we deal with all the negative headwinds we have longer term? And my opinion is, I think that we most likely go into a consolidation period after we kind of correct some of the technical damage on a short-term bounce. And the reason why is really four-pronged. We have the Fed tightening. That's a negative. We have high valuations, right? And those high valuations are a negative. There's nothing else we can say about that. And then if you look at the third thing is economic growth. We're coming off of really robust economic growth on the back of a recovery out of a recession, or what we think was a recession in 2015 to 16. We think that global recession, we've seen a great recovery in that economically, and we think that growth will slow from here going forward. And so as economic growth slows, you have three of the four things we watch in our framework negative. The fourth thing is intermarket relationships and trends. And so what we'll be watching for there is credit spreads to start to widen, like they did yesterday, to tell us, hey, there is newfound stress in the credit markets. And when you get all four of those things pointing at negative outcomes, we think that does suggest a long-term trend change. So we're waiting on credit spreads, which is really the last thing left, and some of the key intermarket relationships like market price trends to confirm the evidence. But yeah, our opinion is that long-term we could be seeing a regime shift here.
So Clint, Scott Minerd was on CNBC yesterday. He spoke to some of these same points, particularly credit spreads. He's calling for some type of short-term bottom before the end of the month potentially, but really more alarming and why it made headlines, his comments made headlines, is he's calling for a 40% pullback by the end of this cycle. Does that fit into your framework of where you see us playing out over the next 3 to 5 years?
Oh, absolutely. I mean, if you look at, it's hard to time exactly when that'll occur or how that will occur, right? What's the path? Because I think the path is important as well. You get a 50% decline from 2000 to 2003. It's far different than a 55% decline in between 2007 and 2009, right? Mm-hmm. You had 40% in a couple of months during the global financial crisis. And so I think the path's hard to determine, but I definitely think Scott Minerd is correct. We actually, I wish I would have seen that article. We echo those sentiments. Short-term market bottom just because we're so oversold and got there so quickly. But longer term, we're facing potential damage that could be pretty large scale, right? I mean, I think 40% is most likely an understatement. If you look at where we are from a price to revenue or a median price to sales ratio on the S&P 500, or market cap to GDP, or to give a hat tip to Dr. John Hussman, a margin adjusted, cyclically adjusted price to earnings ratio. Valuations are the highest they've ever been in the United States. So higher than prior to the Great Depression, where we corrected 90% on the Dow, higher than we were prior to the tech bubble, right? So during 2000, and the NASDAQ corrected 83%. So I think we could definitely see some major market indices get hit at a minimum of 40%. I would think that would be right within the realm of normalcy. I wouldn't be surprised to see some major market indices have 60% declines on an inflation-adjusted basis. And I think that investors should prepare themselves for that possibility. Don't react, don't run stuff money under the mattress, but have a discipline, have a rules-based framework in place to play defense, right? And the markets, it seems like everyone just wants to play offense. I think we have to have a rules-based framework and a risk mitigation framework to play defense as well, right? You wouldn't send a sports team just with an offense to play offense the whole game, right? Probably wouldn't do so hot when the other team had the ball.
That's right.
I think that's the same deal in the market. I think investors have to be prepared to play defense, and they have to have a rules-based framework that makes those decisions for them so that they don't allow their emotional and cognitive biases to creep in, cause them to make bad decisions.
So before we move forward and talk about what advisors and investors should do specifically, I want to go back to that Hussman article you referenced. If you're not following John Hussman, I highly recommend it. He puts out amazing content. His October note even goes as far to lay out the framework for a 66, 67% drawdown in these markets based on absolute facts. And it's a great article. It really should be eye-opening to anybody who allocates money for a living as a financial advisor or investors who are managing their own money. So through that lens, Clint, and the lens that you're looking at the markets through, along with the rules-based strategy, what should advisors and investors do today?
Yeah, I mean, I think always revisit what risk really is, right? And I think revisit the dynamics of risk. So look at the current situation. So if you're an advisor, sit down with your client. This is the time to get in front of this. Sit down with the client, have meaningful conversations about what risk really is. Don't sit down and say, yeah, we've got a 5% probability of a 20% decline in your portfolio. I think you should go through and use tools that really look at historical drawdowns and prepare them for the potential of a worst case scenario. Stress test the portfolio. I think stress testing is really critical, and it helps client conversations, right? It helps have more fruitful conversations in regards to the wealth. To sit and to scare them is to say, hey, let's prepare. Now, if we have this drawdown, what kind of moves should we make in the portfolio, right? Are there any, right? I don't know. That's a client conversation. But I think an advisor needs to have a discipline, and I think the key word is discipline, that allows them to shift an asset allocation between an offensive posture and a defensive posture. I don't think that needs to be great. Our work is spent looking at shifts as small as 20% of equity, right? I think that makes a meaningful impact on in-client outcomes without really shifting them beyond what their quote-unquote stated risk profile or risk and return profile would look like. I think what it allows you to do is straddle the benchmark and make those moves in a disciplined fashion. Now, how do you do it, right? Is this timing? My opinion, it's not timing. You're not trying to time tops and bottoms. You're just shifting exposure to go along the risk spectrum, right? So perfect example. One of the things we've recommended since valuations became high was to start allocating a portion of assets to diversifying strategies such as managed futures and systematic diversified trend following. And I think that's a great way to incorporate a diversifying asset class that, if we go into a prolonged negative trend, should do well because they follow the trend, right? There's other tactical equity opportunities as well, where you have trend followers that are primarily using ETFs to be longer in cash, those ETFs based on a particular set of moving averages or trend filters. I think they will do very, very well in a prolonged negative market. And I think that's what we have to look at. We did a white paper on alternative investing, and we showed how using credit spreads, you could shift between private equity, which we looked at as a return enhancer, and CTAs, or managed futures, terrible names, but trend followers. And we looked at that as a risk mitigator. And we just demonstrated in this paper, although it's not really applicable for actually investing in private equity and then pulling the money and investing in another fund. We showed a way you could replicate it, but it showed a meaningful impact on the end outcome looking historically just by making those tiny shifts in the portfolio. And I think that's an exact example of playing offense and defense and how it can benefit the end investor. So I'd highly encourage advisors to find intelligent asset managers out there who understand the importance of playing defense and to have those conversations with the client about the potential risk in the market. Because if you get in front of this, most advisors are not. And I think that that's going to be a differentiation strategy as well. And it's going to be the advisor adding a tremendous amount of value to the client.
Clint, as someone who works with advisors, I can tell you you're spot on. Advisors are not in front of it. And the time to do this was last year, not today, but if you haven't done it, it's still time. There is still time to make any adjustments that are needed in portfolios. I've long advocated against cap-weighted ETFs because while it feels good while the market's going up, the math tells us there's going to be a whole lot of pain on the downside. A, do you agree? And B, what do you think advisors or investors should do if they have a heavy allocation to cap-weighted indexes?
Oh, I think you're spot on. So I was on a panel not too long ago with S&P, and they were talking about active passive, and I said I don't believe in active passive. I said the whole concept of passive, right? Let's pick on the S&P 500 index. It's not a passive index. The constituents change, and what you're weighting is the highest market capitalization names. And so I wouldn't want to do that, right? I mean, that's not a very good strategy. And there's been so many market strategists out there who've shown, hey, if you bought the highest market cap name, here's what your returns look like over the next 20 years. They're not very good in that name, right?
Yep. Because
it's kind of saying, hey, I've had my run. So it's just a poorly designed strategy. It's hard to outperform because if you're trying to run a disciplined, prudent strategy in the same segment or same universe, look, they're going to weight the names that are growing the fastest from a market cap perspective. And if you were a manager trying to replicate that, your client would be like, why in the world do you have this much in Apple and Amazon? Mm-hmm. Right? They would have like some really hardcore questions for you. So I think, it's poorly designed. I think investors have to get away. I think this is anchoring effect too in real time. I think you have to get away from anchoring to the S&P 500 and to what that index is doing. Even worse would be the Dow, which is a price-weighted index. I think Andrew Lowe came out with a paper recently, Dr. Lowe, and he talked a lot about AI, machine learning, and the future of investing. And I thought it was really interesting and something that we kind of share similar beliefs on, which is that eventually everyone will have their own systematic index, because what an index is a systematic strategy that's rules-based, right? Mm-hmm. And I think that is what we have to get to eventually as an investment community, is that the client and their outcomes matter. Let's design them an index that they can run for them in their situation. And that's why we're such a proponent of rules-based. So I completely agree. Shift away from market cap weighted indices, because if Apple, Amazon, Netflix, these larger names and larger constituents of the index get hit, you're going to be in pain. My opinion is you should factor weight that and weight that to factors that are going to benefit you in the turn of the market cycle. So if you look at things like, if you're a contrarian, look at the value factor, right? Value factors underperformed for quite some time. Quality factors underperformed. I think those are the type of ways you should construct indexes now going forward than just buying a market cap weight and letting it run. So I'm in complete agreement with you.
In addition, if you look at the market this year as it relates to equal weight S&P 500, which is kind of the lazy way to get away from cap weight, it's down 1% year to date. It's underperforming the cap weight. So it sounds to me like putting together a rules-based strategy that has factors that have been tested in real markets could really help protect investors and advisors in the market to come.
Absolutely.
All right. Hey, Clint, this went much longer than I thought it would, and that's because you're a treasure trove of information. I appreciate you coming on today.
Thank you.